While the government tries to hide the consequences of inflation in their official statistics, Americans see and feel it every day. Join the Mises Institute in Tampa on February 17th for our first event of 2024. We'll discuss inflation, its causes, consequences, and cure. Tom DiLorenzo, Joe Salerno, and Patrick Newman will uncover the state's deceit to reveal inflation for what it really is: deliberate debasement of the dollar to create winners and losers. Sign up now at Mises.org/Tampa 2024 and use code ACTION24 for 15% off admission. What is the state? How does it preserve itself? What does it fear? These are the questions Murray Rothbard uncovers in his powerful book, Anatomy of the State. Thanks to our generous donors, the Mises Institute is offering a free copy of this Rothbard classic to Human Action Podcast listeners. Get your copy at Mises.org/HAPod free. That's HA like human action, pod free. This is the Human Action Podcast, where we debunk the economic, political, and even cultural myths of the days. Here's your host, Dr. Bob Murphy.
Hey everyone, welcome back to the Human Action Podcast. For this episode, I am going to be reviewing a debate/conversation I just had with Keynesian economist Dean Baker. And it had to do, the specific topic we were given was, is there going to be a soft or a hard landing in 2024? And so what I'm going to do in this episode of the Human Action Podcast is give my general views, just to distill them down, but also to grab a few excerpts from the discussion. Namely, I want to show some clips of what Dean had to say for himself, because I think it served to highlight the differences between the Austrian and the Keynesian approaches to these matters. So before I dive into the details, I do want to mention, in case you're curious or you just didn't know about this, that the reason I was very pleased, when I was approached by the moderator and said, "Hey, are you interested?" And then he said, "Hey, we can get Dean Baker on the other side of this." I was glad for that choice because, believe it or not, I actually like Dean as a person, and I think he's a worthy opponent in a conversation like this, because I think he's intellectually honest. All right. And that may surprise you, because I think a lot of times people might lump people together and say, "What? Dean Baker, he's like basically Paul Krugman," right? And they agree a lot on the policy conclusions, and in a lot of the online battles that Krugman finds himself in, some might say the fights that he picks, Dean will come in and is on his side. But they, I believe, fight differently, that I think Dean is trying to be fair, whereas I would never accuse Krugman of that. All right, and to give you a specific example, well, I'll give you two. Several years ago, there was this huge debate that ensnared the economics blogging community about whether government deficits somehow burden future generations. Okay, so I'm not going to recapitulate the whole thing right now. I'll put a link in the show notes page for this episode of the Human Action Podcast if you're curious. So it's a fascinating topic. I can't get into it now. It would take us too far afield. But the long and the short of it was, originally Dean Baker and then Krugman jumped in on his side, were arguing that in principle it was nonsense to allege that if we run up the government debt today, that somehow hurts our grandkids, makes our grandkids on net poorer collectively. Like, yeah, there could be distributional issues, but because their insight was, maybe in quotation mark, insight was that, sure, the grandkids are going to grow up in a world where the U.S. government has a higher debt load, but they're also going to grow up in a world where there's more treasury securities owned by mutual funds and their retirement accounts and whatever. That the treasury, when it goes into debt, yes, that's a liability to the taxpayers, but that security that it issues is an asset to somebody. And so they were saying, absent some complicated story about, the the Chinese or something accumulating a huge stockpile of treasuries that our grandkids are then going to have to send net exports over to service, that in general, if we owe it to ourselves, then it's a wash. Like in the aggregate, in terms of the entire generation, like, looking 2 generations ahead. That there could be distributional. So that's kind of what their point was. And there is a serious mistake in that reasoning. Okay, so if you're curious, I'm not even going to tell you. You're going to have to find out on your own. I mean, not your own, but you're going to have to do more work to find the answer. I'll tell you what the answer is, but you got to go to the link where I spell it out. Okay, so that's my teaser for that. But to his credit, I don't know whether it was that Dean read me specifically at the time in those debates, or if he read, the people on my side that I kind of joined in once I realized. It was funny on that one. I started out on Krugman and Dean Baker's side. And then I realized as I got into it, oh, wait, no, actually I was wrong. And I, then once I was sort of like, Saul turning into Paul, that I was the biggest evangelist of the group. Once I realized, oh, wait a minute, I had been thinking about this wrong. It's a lot more subtle, and check this out, folks. Okay, so again, the takeaway is there is a very legitimate sense in which, or there's a mechanism by which it's possible that government deficits today meaningfully impose burdens on our unborn descendants, and there is a meaningful economic sense in which we could be living at their expense. And it doesn't involve time machines, okay? And it's not merely the claim that, we pass down a smaller capital stock if we are more profligate. There's a separate mechanism by which that could be a meaningful statement, what I just said a minute ago about us burdening our grandkids, okay? So, again, to his credit, when I and others on Team Burden showed this mechanism and pointed out the flaw in the glib reasoning, that I just summarized a minute ago, by which you might think, yeah, we pass down the debt, but we also pass down the asset side, so it's a wash, in the aggregate. There's a subtle fallacy involved with that kind of a glib analysis, okay? And so again, to his credit, Dean eventually in that debate admitted and said, okay, yes, I was a bit too strong in the beginning. Theoretically, it could look like blah, 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 but empirically, that's not what's going on, folks. Okay, so I still disagreed with him, but he conceded his original statement was too strong and that he had to fall back on an empirical claim, not a sort of categorical, geez, you just got to think about it for a few seconds and you realize, these people saying that we're partying at the expense of our kids, that's crazy. He realized, oh no, that could be true. I just think it happens not to be. Right? Whereas Krugman never conceded that. The whole time he just kept double, tripling, quadrupling down, saying these people are idiots. And it was clear. And by the way, also, I don't think he was being dishonest. I think he was just being sloppy and overconfident. Because slippery though he is, I think if Krugman had actually gotten our point, he would have just moved the goalposts and, altered his positions to no longer be vulnerable to our counterattack and acted like that was his position all along. That's what I would have expected him to do. But he didn't do that. He just kept leading with his chin and just saying stuff that I was literally coming up with numerical counterexamples just to show, no, Krugman's just totally wrong on this. Like open and shut. Again, not using a Hans Hoppe verbal approach against his quantitative model. No, I was doing numerical examples in Excel showing, in a neoclassical framework, a counterexample to Krugman's sweeping claim, saying, what he's saying is just demonstrably false. He's embarrassing himself here. And so anyway, and Krugman never admitted that, whereas, like I said, Dean saw early on in the debate that he had overstepped, and then he refined what his claims were going forward from that point. So I've always had a respect for him since then. That was years ago. This time around with this stuff, Dean, when I was reviewing his materials going into this debate / conversation, I saw that he openly admitted that, yeah, we think that we got inflation under, and throughout this discussion, what Dean means by inflation is the rate of consumer price inflation, okay? And so I may at times just say inflation as a shorthand, even though in the Austrian tradition, we like to be very careful about distinguishing between monetary inflation and growth in some index of consumer prices, okay? But for in the context here of this episode going forward, should be able to tell if I say inflation, what am I talking about? Okay. Certainly, if I'm pretending to be Dean and saying things from his perspective, when Dean says inflation, he means consumer prices. Okay. So he admitted that, yes, even though it seems like we've gotten consumer price inflation under control without causing a recession, so that guys like Larry Summers were wrong, let me admit, Dean Baker said, in his writings on his blog, the stuff I was prepping for leading up to this conversation, he admitted that I didn't expect this to happen. He said, given what the Fed did with their aggressive rate hikes, which I and Krugman and people thought were too aggressive, I would have thought they would have crashed the economy, that we would already be looking at really high unemployment right now, and we're not. And he admitted that surprised me. I didn't think that was going to happen. Okay, so he wasn't taking back his earlier views. He was just saying, because there's, well, I'll get into it, all right, but I'll spell it out more. That's one of the points I want to make in terms of the substance. But again, my point being, try to distinguish it. Don't just say, oh yeah, anyone who's a Keynesian is an idiot and a liar. No, they actually do conduct themselves differently. And some Keynesians do admit when they made mistakes. Okay, so with all that preamble, let's jump into it. I think probably the first thing I'll do, let me just summarize briefly what my position is. So as far as the question that we were given, what's in store for 2024? And some of this is going to be recycling some of the things that I've been saying on this podcast over the last 12 months, let's say. A lot of joint episodes I did with Jonathan Newman fleshed out some of these points. And I'll put links in the show notes page, folks, to some of the particularly relevant ones, that if some of the things I'm going to say real fast here, if you want to see me with Jonathan at times elaborating, I'll put some links. Okay, so big picture is I do think there is going to be a recession that is officially dated to have started in 2024 that will blossom into what will, after the fact, looking backwards, we'll say, oh, that was a bad recession. Okay, like I think for sure that's gonna be the case. But when I say begins in 2024, keep in mind there's a lag from when a recession ex post looking back, that the NBER, the National Bureau of Economic Research, when they say, yes, that was the beginning of a recession, that they don't know that in real time. Okay, so as things progress, more and more people start thinking, oh, the economy's not good, right? So don't get me wrong, but I'm saying when they wait and then after the fact, looking back, try to determine when are we going to clock it and say that recession officially began. At the time of that, the NBER didn't even know that there was a recession necessarily. They may have thought there are signs that one may be coming or we might be in one, but we don't know yet. Okay, so just it's not like an earthquake or a tornado where, we might have models to try to predict when's it going to happen. But if there is an earthquake or a tornado occurring, you don't have to wait till 6 months later to know that happened. Like, it's pretty obvious. I'm saying with economics, it's not like that. Okay. So I do think that when the dust settles, eventually they will say that a recession began in 2024 and that it will be considered a bad one. I am not confident right now in terms of at what point will it be obvious that a recession has begun, right? Because some would say, well, gee, for a lot of families, there's a recession right now, right? And in that kind of sense, and it's sort of arbitrary, but you get the point. I'm saying that even officially, I think they're going to say there's a recession that began in 2024. So my main line of evidence for that, sort of specific time frame prediction is what's called the inverted yield curve. Very briefly, the idea is, so what is the yield curve? It's showing so I think I'm getting the direction right for you, the viewer, if you're watching the video. Looking like that is what the yield curve normally looks like. It's upward sloping, so that this way is the increase in the duration, like so short-term rates, and then like 3 month, 6 month, 1 year, 5 years, 10 years, 20, 30, like that. And then the vertical is the yield. And so normally the yield curve is upward sloping, meaning the yields on 3-month treasuries are lower than the yields on a 10-year treasury, and then that's even lower than the yield on a 30-year treasury. So the idea being, if the government wants to borrow money from the public, normally they have to pay a higher annualized interest rate for a longer term loan. That, in other words, if you're going to give your money to the government for a longer stretch before they have to pay you back, the principal at least, then they have to promise you a higher annualized rate. Okay, so make sure you realize whenever we say the yield curve and we're plotting the yield, that's always an annualized rate. Like, obviously, lending money for 30 years, you're going to get more total interest than if you only lend it for 3 months, just because it's rolling over for a longer period. But we're abstracting away from it. We're saying even if you adjust and make it apples to apples in terms of the annualized yield, that number at 2 tends to be higher the longer the duration of the loan. However, that's not always true. There are occasions when the yield curve inverts, meaning that the short end is higher than the long end. And so a particular metric that is popular in this literature is the spread between the 10-year treasury yield and the 3-month treasury yield. Okay? And so again, in normal times, the 10-year minus the 3-month is a positive number, because usually the yield on the 10-year is higher than the yield on the 3-month. But that's not always the case. And in our current situation, that hasn't been the case for some time. That the yield on the 3-month has been higher than the yield on the 10-year for a while now. And the gap by historical norms is quite large. Okay, so it's not merely that the yield curve has been inverted for a long time, but the depth of the inversion, or the magnitude of the inversion, is a lot bigger than it normally is. Okay. So who cares? Why did I just spend 3 minutes explaining this bit of trivia to you? Because since at least 1960, so by the way, for those of you who've been hearing me say this stuff a lot, I have been, up till now, often summarizing it by saying since World War II. But actually, because of something I'm going to get into later in this episode, apparently with the recession that began in 1953, apparently the yield curve didn't quite invert before that one. Okay, and so I actually should be more in my published work on this. We are careful. Like, I have a paper with Ryan Griggs that I'll link in the show notes page in the Quarterly Journal of Austrian and Keynesian. So I went and double checked, and I wasn't sloppy there. But I'm just saying, when I've been doing public discussions about this stuff, I think on some occasions I have said since World War II, there's been no false negatives or positives except for like a couple borderline cases. Apparently, no, you're on much safer ground by saying since 1960. Okay, so anyway, but since 1960, that yes, when the yield curve has inverted, specifically the 10-year minus the 3-month, and if you're looking like at the monthly averages, and so to show it's not just a fleeting intraday thing, but like if it's been a sustained inversion, then there is a recession that follows soon after. And there's no false negatives or positives except possibly like one. And even there, it was like there was a slowdown that didn't quite qualify as a recession, but it was still, a sharp slowdown in economic output. Okay, so another way of putting it is to say, if there's not a recession that begins in 2024, then it will be the first time since the 1960s, or since 1960, that you've had such a deep, sustained inversion that was not followed soon after by a recession. One last wild card on this stuff. I think if it is going to happen, it would be in 2024, but strictly speaking, the yield curve has not uninverted yet. So the historical pattern is, maybe actually we'll flash, if you're watching the video, I'll flash it, if you can see that graph we're putting up right now. So you can see that what happens is that the line goes negative, right below the zero axis, and then it bounces back, goes back into positive territory, and then soon after you see the gray bars, which are when the recessions are. Okay, so you can see right now we're still in deeply negative territory. So in order for that pattern to end up coming true again, what would first have to happen before the recession officially begins is the yield curve would have to uninvert. Right now, the yield curve is still inverted as I record this, that the 3-month yield is higher than the 10-year. So for history to repeat itself the way the yield curve pattern typically unfolds, it's got to be the case that the 3-month goes below the 10-year first. And so I'm saying, I keep talking about, oh, this is going to happen in 2024. That assumes that the Fed sees problems coming, starts cutting short rates. Eventually that goes below the 10-year, and then the recession ensues. All right, so strictly speaking, it wouldn't violate the yield curve rule if the yield curve stays inverted all through 2024. That technically wouldn't be a counterexample to the pattern. It's just the reason I'm not saying that is I don't think it's going to stay this inverted that long. I do think, I think it's the tightening that has set in motion the crash, and then so you'd expect the Fed to see that coming and to start loosening. Okay. But anyway, I'm just trying not to leave any loose ends here. Okay. So that's my general view. And also, before I move on, just in case you're concerned, and Dean brought this up in the debate. I'm not going to pull out the clip right now of it because I don't think it's important to quote him on this matter, but just I want to address the fact he was aware of that pattern. And so since he's saying he doesn't think there's going to be a hard landing, he thinks that we did, the Fed pulled it off, or rather the Fed, despite itself, didn't screw it up, that he acknowledges that, yep, this is going to be a time where there's going to be a counterexample to that general pattern. All right, so he's aware of that. And part of his, so what his take was, though, is he said, look, I'm more of a causation guy, not a correlation guy. And then he got into some of the particulars, and I will quote that in a minute here because I want to address it more on the specifics of what he says there. But his point was, yeah, the yield curve normally does that, but you know what? It's not that some lines on a chart are going to cause a recession. I'm looking at more fundamental factors. So yeah, I think it's going to be a violation of that pattern, and I guess maybe it's because of the pandemic or who knows what. But that's not concerning me. The things that I look at was what signals an impending recession just aren't there. So likewise, I want to be clear. I am not merely relying on patterns on charts. That's not the reason I'm so invested in, if that's the way you want to put it, into the yield curve is because I think it dovetails quite nicely with the standard Austrian theory of the business cycle. Okay. And again, that's in the paper I co-authored with Ryan Griggs, if you want to see me spell it. It's also, I did a chapter on this in Understanding Money Mechanics. So if you've got my book on that and there's a free PDF, you can just get the Mises Institute put out. One of the chapters, I think, just literally reproduces that paper I did with Ryan. Okay, so, or some version of it. All right, so the idea being, if you think about the standard Austrian story, it says that the central bank and the banking system collectively, during a boom period, what happens, they flood the market with cheap credit. It pushes interest rates to artificially low levels below the natural rate in some formulations of it. And then that causes malinvestments. Entrepreneurs invest in longer projects than there's really enough genuine savings to fund. And so the economy as a whole goes off on this unsustainable trajectory. And then at some point, a crash is inevitable. It's baked into the cake at that point. And then, what happens in practice is you start seeing warning signs of spikes in certain types of prices. The banks get nervous. The Fed gets nervous. They start hiking, by which it means they stop pumping in money as rapidly. And so that makes, on the margin, interest rates go up. And then, the economy turns and goes into recession. So if you just break that down, it's not so much that the Fed or the banking system controls the interest rate, because there's multiple interest rates. Which one do you mean? Well, most people think they have more control over short-term rates. So if you just think through the pattern of that, okay, so during the boom, when the Fed's pumping money in, the short-term interest rate goes low, so it would lead to an upward sloping yield curve. And then when the Fed slams on the brakes and interest rates rise, short rates rise more than long rates do. In fact, long rates might fall because people have lower price inflation expectations if the Fed's tightening, right? So you might actually see 10-year yields go down a bit, whereas the short rates will spike if the Fed tightens really fast. All right. And then, so that would invert the yield curve. So it's not that the yield curve is causing GDP changes. It's that the Fed, with its monetary policy, is first causing a boom and then allowing the crash to occur by ceasing to fuel the boom. And then you see interest rates respond accordingly, and it just gives this pattern, right? So that's why I like the yield curve as a specific measure, because I think, again, it dovetails nicely with the Austrian theory of what's actually driving the business cycle. Okay. So that's my general view. Oh, and one last thing I'll say on that is I'm open-minded, right? I go and read the people who are saying there's going to be a soft landing, and Dean's no exception here. And a lot of the evidence they offer to show, I don't see any danger in sight. Why would we get a recession here? Look at unemployment's low. We've brought down price inflation, consumer spending, and they go through all these things. And all of those factors were true as of 2007. So specifically, remember, there was the dot-com bubble and bursting in the late 90s, early 2000s that caused a recession. Also, there was the 9/11 attacks. So there was a recession in the early 2000s. Alan Greenspan was the Fed chair at the time. The Fed brought interest rates down pretty rapidly. By June of 2003, the federal funds rate had been brought down to 1%, which was a historic low at that point. It held them there for a year, right? The federal funds rate was held at 1% from June of 2003 to June of 2004. Then the Fed started steadily hiking from June of 2004 forwards. And it was like, I don't know if it was literally every meeting, but just about every meeting. Like, if you look at the chart, it looks like a little staircase of what the federal funds rate looked like in the mid 2000s, like during the housing bubble years. Okay. And so, like, every time they met, they'd raise 25, maybe they did it 50 once in a while, but it was basically 25 basis point hikes every meeting, bring in the federal funds rate from 1% in mid 2004 all the way up to, guess what, 5.25% in, I think it was in 2006 is when they stopped hiking. Okay. And if you looked at the unemployment rate during that period, it was steadily dropping, right? Because it had, the unemployment rate zoomed up during the dot-com crash and that recession that officially occurred in the early 2000s. And then as the recovery began, the unemployment rate drifted downward. And I think they called that a jobless recovery. I might be getting my recessions, but I think that was the one they called a jobless recovery because the unemployment rate did not come down fast, but it did drift downward. Okay. And what's interesting and what's relevant for our discussion right now, even after the Fed, they were done hiking, they had brought rates from 1 back up to 5.25%, and then they stopped because they thought, okay, we've contained these inflationary pressures. That was the thinking. Because remember, like, home prices were surging, and more people started saying, looks like there's a bubble here. I don't know. And so, the Fed was aware of that. That's why they kept hiking, but they didn't want to hike too aggressively because they didn't want to cause a hard landing. And so, as I say, they brought up to 5.25%. And the reason I keep saying 5.25%, in case you don't know, is that's where we are right now. The Fed brought rates up to 5.25% and now is holding pat to see, did we get inflation under control? By which they mean consumer price inflation. Okay, so that happened back then, and guess what? The unemployment rate kept ticking lower for many months after the Fed stopped hiking rates. So that's a main thing as of right now why people are saying we're out of the woods. The Fed stopped hiking. We've clearly broken the back of this, inflationary surge, and unemployment's under 4%. What more do you want? We're fine. And it's not like it's jumping rapidly from month to month. It seems like it's just treading water. Look, we're good. Right? We got through the worst of it. If there had been a problem, we would have already seen it. That's the mentality. And I'm saying that was also true as of late 2006, early 2007. And I'm not just after the fact, looking back and saying, well, someone might have thought. No, Jonathan Newman was the one who found this when I was tweeting about this stuff. And then we worked it into an episode of the Human Action podcast here. There were prominent officials, like from people from the Federal Reserve banks and such, officially saying, we did it, we got a soft landing. Yay. I guess it would be Bernanke at the time. Okay? So I'm not putting words in their mouth. People were running victory laps and saying the Fed had achieved a soft landing as of mid-2007, when the official Great Recession began in December of 2007. You might think it wasn't until the crisis in the fall of 2008 that bad things happened. No, that recession that we call now the Great Recession, because it was the worst one since the 30s, that recession officially began, according to the NBER, in December of 2007. So the fact that 6-7 months earlier, people were running victory laps saying soft landing, because look at unemployment's low. We've definitely gotten these inflationary price or surges under control. We're good. They were wrong. And so the fact that now we have, hey, CPI was kind of out of hand for a while there, but it came back down to more moderate territory. Unemployment seems good. We must have pulled it off, right? No, I don't see why we're having such confidence in that, because again, the same pattern held back then. Okay, so that's my general take. So now let's go ahead and play a clip from Dean to see, what his counter response is.
So Dean, I don't know if you want to maybe just kind of respond there. I can kind of let you guys ping pong on this point here. How do we reconcile all the different data, given what Bob is saying?
Yeah, no, Bob raises a lot of good issues. I also will return the compliments. I've read much of his stuff over the years. And I have to say, even though I'm probably 180 degrees at odds in most ways with the Austrian school, I often find them very interesting. And I learned a lot reading Hayek many, many years ago. So I value the Austrian school, even though I often don't, or I would say generally probably don't agree with their conclusions on policy in particular. Let me just, again, a lot of topics there. I try to look at concrete issues in the economy, and I understand the inverted yield curve, and Bob's right. That's usually a very, very good indicator. But I'm more interested in causality than correlation. So you go, okay, how would we get the recession? And I'm very aware of the optimism in 2005, 2006, 2007. Bob might remember I was out there yelling, housing bubble, housing bubble, housing bubble, and being laughed at. But it was clear to me that we were going to have a very bad story. We were building a huge number of homes, housing construction, residential construction peaked out at, I think we're about 6.8% of GDP. The normal would be around 3.5 to 4. I was saying, well, it's likely to go back there. And we had record vacancy rates, soaring house prices, record vacancy rates. I don't know. That didn't look right to me. Rents weren't rising anywhere close to house prices. Again, you don't expect it to be 1-to-1. You expect it to be in the same general direction. Rents were rising just a hair more in the overall rate of inflation. So I was seeing the housing bubble, and that was clear to me. The bubble was going to burst. When that happened, construction would plummet. House prices were also driving consumption. You could see that. I mean, it wasn't a secret. You could see that the savings rate had gone to record low levels at that point. But on top of that, Greenspan was even writing about this, that people were cashing out money. They're refinancing. We had cash out refinancing. So someone take advantage of the low rates. We had low mortgage rates. They take advantage of those, and then they take out $20,000, $30,000 and use it to buy a car, take a vacation. Maybe they're paying for the kids' school. So I'm not saying it's a bad thing, but the point was it was spurring consumption, and this was all easy to see. So for me, when I was looking at the economy in those years, I'm going, this is going to crash, and we're going to have a bad recession. So these were all things you could point to, very, very identifiable. So I look at the economy today and I go, okay, what would give us this recession? What would give us the hard landing? So housing market. We saw already a fall off in starts. Could that fall further? Sure, but I don't know why it would. If anything, it looks like starts are bouncing back up. They're not at real high levels, but they seem to be going up, not down. I don't see a story that would cause them to go lower. Consumption otherwise, well, if real wages are growing, why wouldn't consumption keep growing? That's kind of what we're seeing. So consumption looks strong. Investment side, it's not as strong as we might like if we look at equipment investment. Structure investment is soaring. This is a direct result. You're welcome not to like them, but I would say it's pretty clear the result of the Biden bills, the Infrastructure Act, the CHIPS Act, the Inflation Reduction Act. Structure investment is soaring. And again, would that turn around? Well, of course it can, but it's hard to see why it would, and certainly why it would anytime soon. When we look at investment in intellectual products, we had the Screen Actors Guild strike, which slowed, a big chunk of it. People don't realize that's actually a big chunk of the economy, certainly in California. That's over, so that's going to get up and running again. So you look at these things, they all look to be going in the right direction.
Okay, so first of all, I do want to point out it's interesting because on the one hand, normally it's the Austrians who say there's not this distinction between micro and macroeconomics. That's like a Keynesian invention. And it feeds into the fact that even today, if you go to a mainstream program, microeconomics, they're going to be talking about market failure and there's negative externalities with climate change and we might need a carbon tax. Okay, they do that kind of stuff. But generally speaking, most Austrian economists are going to be okay with the general concepts that are communicated in an intro micro class. Okay, they might not like some of the garb in which it's placed and whatnot, with indifference curves and things, depending on how mathematical the program is. But the basic idea, there's households and they maximize their utility subject to a budget constraint, and the firms maximize profits, and there's this and that, and gains from trade and free trade is generally good, and blah blah blah. They'll usually show price controls can lead to problems. Even in a mainstream class, they'll be able to do stuff like that. That's typically okay. Whereas then, and in particular, there's scarcity, right? Like prices communicate information and so on. And if one sector expands, well, then other ones have to contract. Whereas that all goes out the window often when you then go to your intro macro class. Then there's a whole new set of models that don't have anything to do with what you learned in micro, and in fact give answers that flip the results that you would have thought from a standard micro class. All right. There's the paradox of thrift. There's, okay. So the fallacy of composition. You can't assume that just because something makes sense for one household to do, it's possible that if all 300 million households do it, the opposite result pops out, right? There's those kinds of paradoxes and such. And so normally a standard Austrian response to that bifurcation is to say that's spurious, that's a Keynesian artifact. No, economics is economics, and if you really want to understand the business cycle, you need to start, if you're in the Misesian tradition, you need to start with, human action is an axiom, and just start building up the whole body of economic thought from there. And eventually, yes, you can handle complex things like the boom-bust cycle, but they're all ultimately built on micro foundations. And it's not that there's one type of economics that you use for macro problems, and then there's a completely different body of economic theory that you deploy to figure out how much should a baseball player earn, which is kind of how it happens in a standard mainstream course or projection, sequence of courses. Okay? So it's ironic, given that context, that here it looks like for our dispute about whether a recession is coming in 2024 or not, that I'm relying on big macro indicators like inverted yield curve, and hey, the Fed had expansionary monetary. This is something I didn't mention here. I mentioned it in the debate. I just forgot. Another signal to just show that the Fed really did have loose money and now tightened is the fact that M2 zoomed up, especially during 2020 during the lockdowns, and then now it's coming down hard. Historically speaking, right? It's down something like 4.5%. And the last time M2 dropped this much was in the early 30s. It dropped by more back then. But I'm saying to find what, when did M2 come down more than 4.5% in a single stretch? You have to go back to the early 30s to see that. And the economy was not in good shape in the early 30s. Okay? So it's ironic perhaps that when I'm giving evidence like that for why I think the economy's in trouble in 2024, that the way Dean's responding is to say, yeah, I don't care about big macro aggregates and stuff like that. I'm getting my hands in the nitty gritty. I'm looking at the people in the trenches, the boots on the ground, and I don't see any problem. So, the recession has to come from something. There's got to be some more specific cause than just lines on a graph. I don't see where's this trouble going to come from, right? So it's interesting that that's the way, he and I ended up grappling with each other in this, because that flips normally what you'd expect in terms of Austrian versus Keynesian, micro versus macro. So having said all that, though, a few things I want to say in response. So one is, yes, it is true, and to be consistent with the Austrian method throughout, that ultimately the reason there's a recession, it's not because there's economic forces and principles that operate at the macro level that have no mooring in the micro. Everything is ultimately a result of human action in the Austrian framework. So of course, any particular recession you ultimately in principle could trace back to, specific cause and effect relationships carried out by individual humans making choices. But the idea is an economy is so complex, right? I can't just take a snapshot of the economy right now and say, oh, clearly, here, let's put this diagram up on the let's put it up on the big board and we'll see. And, here, I get my Sharpie out like John Madden and I start making circles and, oh, there's a problem. And, oh, in 6 months, you're going to see a problem right there. And there's going to be a bottleneck. No, because if I could do that, I could centrally plan the economy, right? So no, we can't take a snapshot of the structure of production and look at it and say, oh yeah, there's a problem right there. Those chickens are going to come home to roost 6 months from now. I mean, somebody who makes a career, and maybe with AI and whatever, there's a sense in which certain types of investors, they do things like that. But I'm saying that's not me, right? And also I think they have limited degrees of success, and that clearly nobody could be utterly confident in what they're doing, because somebody who were that able, then central planning would be possible. Okay, but since we're saying that no, you can't centrally plan an economy, that's the reason you need private property and money prices, is to steer entrepreneurs away, because it's not obvious. It's not merely that it's not obvious, it's not even capable of being determined with all kinds of supercomputers on your side as to what, the right amounts of investments and we need this many hammers to be produced in this factory, and these farmers should plant this many acres of crops over here, and and what type of crop, and okay, and these truckers ought to take this. No, there can't be one mind in charge of all that, or even be able to comprehend it. That stuff is all dispersed. The problem's broken down into smaller chunks and dispersed to people, more local decision makers. It's decentralized. All that stuff. Okay, so that's kind of the essence of the Mises and Hayek positions in the socialist calculation debate, and we can get it. Yes, there's distinctions between their views and whatever. I'm not going to get into that stuff right now. Okay, so that's kind of what's going on here. But having said all that, it doesn't mean we're completely in the dark. We understand the role that prices play in helping to coordinate all that, and in particular, interest rates play a strong role in intertemporal coordination, making sure that long-run planning is coherent. That everybody in the economy, we've each got our different planning horizons. And how is it that all of our plans could even be capable of being in sync with each other, mutually compatible? And the Austrians have written a lot on that. And, so Mises, had some canonical statements, and then like Israel Kirzner did a lot trying to flesh that out, that particular element of Mises' thought. And, Hayek has a lot of stuff on that too, with his so-called knowledge papers, if you're familiar with those. Okay, so we're doing more about like explaining this is the way the institutions of a market economy help people grapple with these extremely complex problems. And so, right, I can't just look around right now and tell you, oh yeah, here's where the problem's brewing and and they're that, in the argument with Dean or the conversation, I did throw out some things. I was saying how, it looks to me like residential housing is overpriced, and I know commercial real estate, they're still in trouble and blah, blah, blah. And I think the banking system is still sitting on a lot of unrealized losses on their treasuries and other fixed income assets because of the rapid hike in interest rates, blah, blah, blah. But, if I didn't have my antecedent framework of Austrian business cycle theory supplemented with the empirical regularities of the yield curve that, dovetail with the qualitative statements of that theory, I would not be confidently looking at those things and saying that's going to be a problem. I wouldn't know whether that was a big deal or, oh yeah, that's just something that's going to get washed out elsewhere. Okay, but it's knowing how the economy works when market forces are allowed without, excessive interference to function and to do their job. Now looking at what the Fed did in 2020, realized that, oh, no, that's not good at all. All right, that's setting us up for a crash. Okay. I don't know if this is a good analogy or not, but maybe it's like if somebody takes like a vial of deadly poison and drinks it, okay, and I could say, that's not going to be good. I bet you within 2 hours, you're going to be really sick. And then they say, okay, point to the cells right now in my body. Where's the problem? I don't have a problem right now. You get what I'm saying? Like, even if it's sitting in your stomach at the moment, like maybe, you couldn't. All I would be doing is repeating the knowledge that, I know drinking poison's not good for you. And I know that's going to lead to trouble, but I couldn't zoom into your individual cells and start pointing out and saying, oh yeah, see the way this cell looks right now? Well, clearly within 2 hours, it's going to turn into such, like, I wouldn't be able to do that because your body's so complex and everything. All right, so I don't know if that's a helpful analogy or just muddying the waters, but that's kind of my take on that. Okay, another thing I want to point out is that notice what's interesting, that when Dean did try to give the economy a clean bill of health, I just want to point out that one of the things he said was, see, look, consumer spending's fine. And so I think I'm not like making fun of him or something. I'm just trying to stress the difference in the Austrian versus the Keynesian approach, that from an Austrian perspective, it's not that the economy goes into recession because people become afraid to spend money, right? As we like to say, if that really were the issue, well, then there'd never need to be a recession. And I know the Keynesians say, right, the government should just come in and run deficit spending. That's what we've been saying since the 30s. And you hammerheads, you fiscal hawks, you people who hate the poor, you won't let us do it. We're always on the verge of solving the recession if you just let us deficit spend a little bit more and then you chicken out at the last minute. And then that's why, even though we just ran, an unprecedentedly big budget deficit, it didn't quite work because you didn't let it do its job. You guys always take the punch bowl away right when it's about to work. And so even though historically our huge deficit spending tends to go hand in hand with a worsening economy, the Keynesians would say, plausibly from their framework, yeah, duh, of course you see the biggest deficits going hand in hand with the worst economies because that's the medicine. Just like, who gets the worst doses, the highest doses of chemotherapy? People with cancer, that's who. And that doesn't, we haven't just proven that chemotherapy causes cancer, right? Right. So that's where the Keynesians come from. Whereas the Austrians, given our framework, could plausibly say, no, the last thing in the world you want to do if the economy is already on the ropes is have the political sector siphon more resources away from the private sector through deficit spending and have resources be directed because of political whims rather than market forces. What are you doing? And it's not surprising that FDR comes into office and then that entire decade is just garbage, that we had the longest depression in U.S. history when first Hoover and then FDR did the most peacetime interventions in the economy to, quote, help things. It's not a coincidence that the most aggressive forms of help from the federal government went hand in hand with the worst economic disaster in U.S. history. That's what you would expect if those remedies were in fact bad. That's what it would look like, right? So both sides are kind of, yep, we nailed it, looking at the same data. Because again, their antecedent theories are so different, and in economics, there aren't really controlled experiments. And so after the fact, both sides, given their ideological frameworks, can come up with a story and reconcile, there's some cherry picking involved, that we pick and choose the facts that help us make our case, but we don't need to lie, is what I'm saying. We can just go look at what's the available evidence, and a good economist, well, let's say a clever economist, and there's lots of them, can pick and choose from the available evidence to make a story to say, see, we told you. Either deficit spending for the win or deficit spending caused the disaster, just like we told you. Okay, but in any event, again, I just want to underscore, highlight that distinction that in Dean's framework, what might cause a recession is if consumers get scared and get stingy with their money. Whereas in the Austrian view, that's not really that. No, it's how if there aren't goods on the shelves, it doesn't matter how much consumers are willing to spend. And how do goods get on shelves? It's not enough just that the business people anticipate sales. That no, they have to. If the people running Target and Walmart and Best Buy, it's not enough that they think, oh yeah, there's going into the Christmas season, we think merchandise is going to be flying off the shelves. Let's go put in a bunch of big orders. If the manufacturers can't get workers or they don't have enough resources to cater to that demand, it doesn't matter, right? So the Austrians tend to focus on the, quote, real factors involved and say that, yeah, when there's a recession, it's because there was an underlying imbalance in the overall structure of production. And that it's like the economy is almost like a picture, like a giant pipeline. And lots of things have to be set in motion years earlier in order for you to walk into the grocery store and just see everything laid out nicely on the shelves. A lot of stuff had to be set in motion far in advance for that outcome to occur. And you just sort of take it for granted. And it's not, the critical part of that story is not, are consumers willing to show up and hand over dollar bills or swipe their debit card in order to get milk and eggs and grapes. That's not that. Yeah, I mean, that's part of the story of how it all fits together, but that's not really a big deal in the grand scheme of things. Okay, so again, just to highlight that difference, why don't we play another clip from Dean here to emphasize another difference in the standard Austrian versus Keynesian view.
Okay, I should probably at this point just clarify, and I'm curious too, Dean, what your take is on this, that when I talk about the Fed like cutting rates or raising rates, that's shorthand. I mean, yes, that's the official policy tool they're using, but in my framework, the reason that really has an impact on, the direction of investment and the structure of production and so forth is because it's affecting the rate of money growth. And so, so specifically here, like when I say the Fed tightened, I mean, again, you could like debate from like mid 2022, the monetary base has been trending down. Like I say, M2 is down, I think like 4.5%, something like that, which again is the biggest drop. So normally for listeners who don't know, like M2 kind of typically just grows and it's just the rate of growth is higher or lower. But here to actually have come down 4.5%, something like that, that hasn't happened since the early 30s. And that was not a particularly good time for the economy then. So that's what I mean when I say the Fed hiking rates. That's really what I mean. I guess I'm just curious. Is that too, Dean, where you're coming from, or do you actually think it's more like the actual level of the interest rate that's the relevant issue?
I do think it's the level of interest rates. You know, I am of course familiar with, you know, the monetary arguments. I don't follow them closely, in part because I just don't think they matter that much, apart from their impact on interest rates. So, you know, so insofar as, you know, the tightening of the money supply is leading to a jump in rates, that matters. But, you know, but it's not in isolation, in other words. And obviously they obviously interact. But I'm saying, you know, if we had a big movement one way or the other in money supply that, for whatever reason, isn't having an impact on interest rates, that wouldn't concern me.
Okay, so there again, I don't need to spend too much time on this, but I just want to point that out, that I didn't know that Dean was going to say that. That's why I asked him. I wasn't just doing it for the sake of the audience. I actually genuinely was curious as to how Dean would handle that. So it's funny, guys like Scott Sumner, who's what's called a market monetarist, gets frustrated a lot, and he accuses guys like me of often focusing on interest rates and thinking that, oh, Fed policy is either loose or tight because look at interest rates. If interest rates are really low, then, oh, the Fed's loose and this is going to lead to bubbles. And if the Fed raises rates, then, oh, gee, they're slamming on the brakes. It's going to cause a crash. And Sumner's point is that I can't believe we as economists are still falling into this verbal trap. Didn't Milton Friedman and Anna Schwartz shake us out of this foolishness, you know, decades ago, by pointing out that really what you want to do is look at monetary aggregates. That's much more informative than interest rates, because in particular, if monetary policy has actually been really tight for a long time, then you would expect nominal interest rates to be low, right? And just think through, why would that be? Because if monetary policy has been tight, right, like the rate of money growth has been low or even negative, like the quantity of money has actually been falling, well then, you know, prices come crashing down, or at least price growth collapses so that prices stay steady. And so when people are lending and borrowing money, it's a twofold thing. That on the one hand, they think that real growth is going to be low, because typically like a suddenly tight monetary policy would dampen conventional growth. And then on top of that, price inflation's lower. So when you try to say like, hey, if I want to borrow $1,000 from somebody for 5 years, how much interest in terms of nominal interest rates should I be willing to agree to pay back? If I think we're kind of in store for a low growth economy in real terms, and I think price inflation is going to be low, well then I'm not going to agree on a high interest rate, because, you know, how am I going to come up with the money to pay that interest, right? And the lender, from his point of view, he doesn't have attractive real returns by directly investing in operations and things, because the economy, the real prospects are bad. But he also isn't as worried about, you know, getting back his purchasing power, because, oh, if I think CPI inflation is going to be low over the next several years, so he'd be willing to lend at a lower rate. Okay, so that's why tight policy, if it's been enforced for a bit, you would expect to go hand in hand with actually low interest rates, whereas really loose monetary policy, if it's been in swing for a bit, you would expect to see going hand in hand with high interest rates. Because, right, if there's an inflationary boom underway, for sure CPI inflation's real high. And so just because of the purchasing power element, when someone's lending $1,000 for 5 years, they're going to want to get a decent rate of return on that measured in dollars, just because, hey, when you pay me back, if you just paid me back $1,000 5 years from now, that's not going to buy very much in terms of real goods, because let's say, you know, CPI inflation is running at 20%. So you would need to get at least made whole on that score. And then also it's possible, depending on the situation, during it, you know, in the upswing of an inflationary boom, that maybe unemployment comes down and factories really are cranking stuff out in that, you know, sliver of time. And so maybe you think real economic growth is going to be good for a bit. So that's another reason borrowers would be willing to pay and lenders would demand higher interest rates, other things equal. And so that's why loose policy by the central bank actually goes hand in hand with higher interest rates. So notice that's the flip of what you normally hear in the press or whatever, right? Normally it's, oh, if the Fed cut rates, that's supposed to be loose policy. The Fed's easing. And if the Fed hiked rates, that's supposed to mean they're slamming on the brakes, right? So you just have to be careful, right? So I'm cognizant of that. And when I am talking about the Fed cut rates and going into 2020, looking at the monetary aggregates, those things went through the roof too. And then when I say the Fed tightened, it's also that like since mid 2022, the monetary base, like the Fed's total assets have been coming down and actually dropping. I don't just mean the rate of growth has slowed. I mean, no, the actual size of the Fed's balance sheet has been shrinking since mid 2022. And there was like a brief surge at one point, but the general trend has been downward. And like I say, M2 has come down quite a bit by historical norms. Okay, so that's just keep that in mind. Whereas again, as Dean just indicated, for him, it's all about interest rates. And why is that? Because from his point of view, managing aggregate demand is the issue. And so I'm not, I can't get inside his head. I would still have thought, and that's why I asked him, because I was open to the possibility that they would say, oh yeah, ultimately, the more money that exists, the more aggregate demand there can be, other things equal. But you heard it from him. He thinks, no, the only reason money supply matters is it might affect the level of the interest rate. Okay, fair enough. Okay, last quick point I want to make is this team transitory stuff. And so here, the issue is, well, let me just restate what my general take was. And Dean actually kind of laughed at it. So here, I'll actually play the clip because I was glad to see he didn't get mad that he thought it was funny. So here, we'll play the clip.
So maybe this is a good time, Dean, for me to, because this is my take on the whole like team transitory Larry Summers debate. It seemed like both sides, again, painting with a broad brush, that the Larry Summers side was saying, as of early, 2021, hey guys, inflation is starting to creep up and it's going to get out of hand here. We need to nip it in the bud. The Fed needs to hike rates and so on. And unfortunately, that's going to cause a big surge in unemployment. Sorry, but that's just the way it works. And then guys like Krugman were saying, no, this was all a transitory thing, that the Fed should not raise rates. Inflation will come down on its own. And if it were to raise rates, that would cause an unnecessary recession. And so then the Fed did hike rates very aggressively, and M2, came crashing down too. It's not just the rate hike. They weren't just passively they were slowing money growth, reversing it. And unemployment didn't go up. So it seems to me like, in a sense, both sides were actually kind of wrong. That, if you get what I'm saying. So, so where we are right now is kind of weird. Like, I don't think either side actually predicted where we are right now, that the Fed would raise rates and unemployment would just be treading water. So let me stop there. Am I right in saying that, Dean?
Oh, completely. I think most of the people who came into are arguing against, be clear. I thought the Fed should raise rates, and, as did, I think, Krugman. I won't put words in his mouth, but not as drastically as they did. And my expectation was, with the drastic rate hikes they had, it would have a big impact on unemployment, and it didn't.
Okay, so just to reiterate, in case it didn't come through clearly there, the idea was that both sides were partially wrong, because the Larry Summers side, as of early 2021, was saying the Fed needs to hike rates in order to combat inflation. Sorry, that means unemployment's going to go up. Krugman et al. Were saying, no, don't hike rates because that will make unemployment go up, and we don't need to. You're doing that because your goal is to bring down price inflation, and I'm telling you, just wait. It'll come down on its own, or have very tepid rate hikes, but let's err on the side of letting things run hot for a bit, because trust me, a lot of this is supply bottlenecks from the pandemic. It's not because consumers have too much money. That's not what's going on here. Or it's not that there's this wage price spiral because of worker gains. That's not what's going on, Krugman said. So both sides agreed, if the Fed hikes rates, it's going to cause unemployment. It's just Summers thought, we need to do that. Sorry, it's the harsh medicine, but we need it because we're sick. And Krugman was saying, no, we don't need to drink the yucky medicine. I think we're going to get over this cold on our own. right? And so what did happen, in fact, is the Fed did hike rates aggressively, clearly not listening to Krugman, and we didn't get the huge surge in unemployment that both sides predicted would happen. And yet now Krugman's running victory lap saying, see, I told you, price inflation came down, and it wasn't, because of, it was obviously transitory because it came down and we didn't see rising unemployment. And he's acting like he's totally vindicated when, okay, but you said it was going to come down on its own without rate hikes. And you said if the Fed did hike rates, it would cause massive unemployment. So you're wrong. It's not that everything you said came true, right? Now, and like I said, so Dean did admit that right, and he includes himself in that, saying he thought we would have seen higher unemployment right now than we do see, given what the Fed did. Okay, so again, I respect Dean for admitting that. Okay, now in fairness to the Keynesians, it is true. If you, at least looking at U.S. data, I started going back through all the recessions, and it is true that generally speaking, what happens is if you have high CPI inflation, by which I mean like over the prior 12 months, what's the percentage increase in the CPI? That's the measure I looked at specifically, in case you care. So anytime that, generally, looking backwards from today, anytime that CPI measure of inflation had been pretty high and then came down fast, that went hand in hand with a concurrent, a simultaneous increase in the unemployment rate. And so from that perspective, that's why now, because CPI inflation had been pretty high and then came down, it's not in the Fed's preferred range. And I know a lot of people watching this episode right now think the government is understating the actual rate of price inflation. I get all that, but I'm just saying, according to the official measure, it was real high and then it came down pretty rapidly, and unemployment did not spike. And yes, that number is also somewhat bogus, that there's a lot of people who still have not come back into the labor force, and so the official unemployment rate might be masking I get all that, stipulate all that. I'm just saying, from the Keynesian perspective, this is why they think soft landing is in store, mission accomplished, is because in their framework, typically, if CPI inflation came down that fast, you would have seen a spike in unemployment. And since we haven't seen that, they figure, okay, we must have gotten lucky this time, or not luck, due to the pandemic or whatever. You can see it, though. I did, if you go back far enough, it's specifically, so we'll flash this up on the screen. Looking back at the early 1950s. All right, and so this chart we're looking at, so the blue line is the prior 12-month rate of consumer price inflation. And you can see that in early 1951, that had risen rapidly, such that by, in the 50s or in 1950, and then by early 1951, that peaked at, it was like 9.6%. All right. So just shy of double-digit inflation in the conventional parlance. And then it came down rapidly, such that by early 1953, it was 0.7%. Okay, so price inflation went from being almost 10% to being below 1% in just 24 months. Okay, so that's a huge drop. And yet, you see on the same chart, the red line, that's the unemployment rate. And that basically was either gently falling or flat that entire time. That when the price inflation was at its peak, the unemployment rate was at 3.1%. And, back when price inflation was at rock bottom levels, the unemployment rate was actually 2.9%. Okay, so you can see here's a historical case where CPI inflation came down a lot and the unemployment rate didn't zoom up. Now, what's going on here? This has got to be due to the Korean War, I imagine, is that there was, big military expenditures, and then they went away, and then that's partly what allowed price inflation to come. And by the way, in conjunction with the Federal Reserve, right? So just merely the government spending more money, if that's not accommodated by the central bank, that's not necessarily a huge factor in terms of price inflation. So that's just a little nitpick that sometimes I think people on the free market side of things automatically say, "Oh yeah, big government spending is causing consumer price inflation." Well, if you had a genuinely hard money standard and the government had to either tax or borrow every dollar it spent, and it wasn't at all accommodated by an increase in the production of dollars by the Fed, then I don't think that it would be nearly as pronounced. But in any event, so I think that's what's going on. So the point here I'll end on is Dean was aware of this episode, and he was like, yeah, see, that's kind of what we're hoping we pull off again. So this isn't like a weird counterexample. This is exactly our point, Bob. What do you mean? That you're able to do this at times. And so, but my point is looking at this, I don't see how you'd fit this into their story, because it wasn't like there was a pandemic here, right? That even if in their story the issue was the high prices were fueled by the one-off U.S. entry into the Korean, what was it called, police action. It wasn't actually a declaration of war. I would still think in their framework, at least as a first pass, that it would be, no, if you had huge government spending and that led to full employment and rising prices and, aggregate demand, the economy was overheating, and then the government quickly slammed on the brakes in the sense that they drastically cut military expenditures such that CPI inflation went from 9%, almost 10%, to 24 months later, it was below 1%. You would have thought that would go hand in hand with a surge in unemployment. Maybe not 8% or something, but surely you would have thought it would tick up a few points. And no, it kept falling to below 3%. That's crazy, I would think. So I think that episode is hard to reconcile with the Keynesian story. Because again, it's not like there was some huge supply chain issue that was then freed up. Like, I think that was just a standard story of government spending, redirecting resources into the military sector. Okay. Maybe if they did a deal with like the men being sent overseas and then coming back and then get back into the peacetime labor force, I guess maybe you could tell a story that way. That would be a mechanism, but it would have to involve something like that, not just a change in the spending patterns. Okay, so last thing I'll mention is, so here you do see on the same chart, the green line is the 3-month Treasury yield. Unfortunately, I can't get data, at least on Fred, showing what the 10-year yields are back this far. They typically, the series I had available would only go back like to the early 60s at best. So I can't look at what the 10-year minus 3-month spread is, but I did review some of the academic literature on the yield curve inversion stuff. And apparently this recession is not one that is not a feather in the cap of the yield curve as a predictor. Okay, so in other words, the yield curve apparently did not invert in the early 50s to then, quote, signal that recession that you see beginning in mid 53. Having said all that, though, the reason I was trying to dig up the 10-year is because you can see the 3-month did still go up, right? It didn't zoom up, but it basically doubled. In terms of when this blue line starts come crashing down, the green line is steadily marching upward. So the 3-month, for example, in January of 1950, the 3-month yield is 1.07%. And then by January of 53, the 3-month yield had gone up to 1.96%. All right. So it's in the great, in absolute terms, it's not that big of a move, but it did double, if you want to think of it that way. Okay. So I would be curious to see if you overlay the 10-year on this. Did the yield curve, it didn't absolutely invert, but did it flatten out in this period? My guess is it probably did. so that it's still, the broader rule of the yield curve tends to flatten before a recession, that could still be possibly exhibited or illustrated by this particular example. Okay, well, that's a good spot to wrap up. I will, of course, put a link to the full discussion between Dean Baker and myself if you're curious, and some other things that I touched on in this episode. Thanks for your attention, everybody. We'll see you next time.
Check back next week for a new episode of the Human Action Podcast. In the meantime, you can find more content like this on Mises.org.